Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. Guys, we are so excited to be with you this week. We've got an awesome show lined up for you. We are going to take a deep dive through the data, tiptoe through the tulips. We're going to give you all the information that you need, the tips, the tricks, the strategies, the answers to your questions, so you can go out and make better real estate and mortgage decisions for you and your family. Jen's back there shaking her head, wondering, how can I ever get through an episode without letting Mark saying, I don't know, I just slip it in there. But speaking of Jen, she is standing by womaning the Anytime hotline. If you've got questions or comments as the show unfolds, please feel free to call or text 855-462-7292. That's 855-462-7292. 855-462-7292. That is the Anytime hotline. As I mentioned, she's womaning the hotline. She'll get your questions on the air. If you prefer, you can visit MrMortgageRadio.com. That's MrMortgageRadio.com. Click that big yellowish, orangish button that says get your questions on the air, and you can type your question there. It'll pop right up on Jen's screen, and she'll read your question on the air for you. But man, I'm excited. I'm frustrated. I'm confused. I'm angry and encouraged all at the same time, because this freight train of a housing market and these interest rates just have everybody frustrated and confused. And we're going to dissect some of this and hopefully make sense of it for you. First of all, man, housing continues in the face of these higher interest rates to hold value and continue to appreciate in a lot of markets. And that's just got everybody befuddled. And a lot of people who have been waiting this interest rate market out have only cost themselves equity opportunity. So we're going to look at that. What's the likelihood that rates continue to rise versus a pullback? Because the pundits who have been calling for a pullback have been wrong for a while. We're going to try to make sense of all of that for you. But hey, let's start right off. I found this interesting. We're looking at this ridiculously overheated economy and all of these rate hikes attempting to slow the economy, and then last week's job numbers, double expectations almost, clearly indicating that this economy is still on fire. And then this week we had the producer price index, is the cost of the materials and services needed for these companies to manufacture and distribute their products. Well, guys, that number was higher than expected. We were looking for a 0.3% increase. We came in at 0.5. And then I love the spin doctors, because one set of spin doctors say, you know, we missed to the upside, right? We were expecting 0.3. It's 0.5. It's still hotter than expected. And then the other set of spin doctors says, yes, but last reporting period, we were at 0.7. So we are going down just at a slower than anticipated pace, which has the average of us out here in the real world just scratching our head. And I used an analogy a week or two ago. It's like trying to figure out if the tide is going up or down by just watching the waves, because even when the tide's going down, the waves are crashing up and coming back and up and coming back. And if you're just watching those little finite moves, you really don't have a good indication of the overall direction of that tide. So I think for the average of us out here who are just trying to make the best decisions we can, sometimes we look too closely and we're doing nothing but confusing ourselves. So certainly something to pay attention to. Inflation overall definitely has a hold on this economy, which indicates that there is likely at least one more rate hike in our near-term future. So brace for that. It's probably coming. Might not be the Christmas present everybody wants, but 'tis the season for rate hikes based on this inflation data. So here's another one that's kind of frightening. Last month, we saw some data released that credit card delinquencies are on the rise, which is not a surprise because a month or two ago, we saw that we've crossed the $1 trillion mark in credit card debt for the first time in our country's history. So as interest rates go up, those payments go up. And that $1 trillion was the balance, guys. So if you're servicing $1 trillion worth of credit card debt at 10% and now it's 20%, that's a huge, huge difference. So I don't think many people were surprised to see that delinquency rate jump. And because of that, this data that I saw this week didn't really surprise me, but it's just kind of a sign of the times. 5.1% of employed Americans have a side hustle. That's over 8 million people. 8,137,000 people are working more than one job just to keep the wolves away from the door, and that number's on the rise. I don't know how much of that job creation report had anything to do with people taking additional jobs, but that number's up from 7.5 million people this time last year. So clearly there's more pain on the horizon in the economy. Now, I say all that not to scare you, but we are definitely dividing a deeper and deeper line in the sand between the haves and the have-nots. Because if you're a homeowner right now, you are equity rich, especially if you bought your house 24, 36 months or longer ago. You never dreamed you would have this much equity. And we've talked about it. We're seeing people utilize that equity to take advantage of some of the opportunity in the market. ATTOM Research just released a data set that showed in over 500 U.S. counties, I think it was 575 U.S. counties, that they analyzed the data. 99% of the people in those counties can't afford to buy a home in that county, even though the average salary in this analysis was $71,000. Because of that, more and more people are going to be forced to rent. So we're seeing people who have equity in their homes cashing some of that equity out and buying rental properties. We're seeing people cash some of that equity out and helping their children or grandchildren with down payments or higher education. So yes, this is frustrating and bad news, if you will, for a portion of society. But for a large portion of society, they've never had this much buying power. And there's opportunity in all of this. There's great opportunity in assumable mortgages right now. And we talked about that a few episodes ago. And we've gotten a load of interest about that app where you can search assumable mortgage properties for sale. And we're seeing that become a significant opportunity in the market. So guys, doom and gloom is definitely in the headlines, but through the raindrops, there are some opportunities. And I really want to focus on that because we can't undo what's been done. This is the lump of reality in our lap. We just need to do our very best to navigate through the circumstances that we have in front of us. And I think there's a lot of opportunity that exists out there. So, hey guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Drowning in bills? Struggling with mounting debts? The Rec Refi is here to throw you a lifeline because your dreams matter, and so does your financial wellness. Visit recrefi.com. That's recrefi.com. The Rec Refi, reduce, eliminate, consolidate. Visit recrefi.com, your beacon of hope in a sea of debts. A service of Mark Eitel, NMLS number 1929005, and the Mr. Mortgage Team.
Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, we appreciate you being along for the ride, and we encourage your participation. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is womanning the hotline. She'll get you on the air. If you would rather do it online, just head over to mrmortgageradio.com. That's mrmortgageradio.com. The new and improved mrmortgageradio.com. There's a big button. You can't miss it. It says Get Your Questions on the Air. Click that button, type your question in, and Jen will read it on the air for you. But man, I appreciate you letting me get a little philosophical about raindrops and opportunity in that opening segment. I just think that it's, this is the hand we're dealt, and we've got to do the very best that we can with it. And I do think there is opportunity to win out there in the market, whether it's people taking advantage of some of their equity and doing debt consolidation loans to offset some of that ridiculously high interest that they have in credit cards or even equity lines. Man, those interest rates have jumped considerably with the rec refi. And guys, if you want to do your own debt consolidation calculation, go to refi.com. That's recrefi.com. We put that website up there. Use the calculator, see what you think. If you have questions, shoot us an email. But a lot of people are surprised that even though rates are up, and up considerably, a lot of people can still save money each month. And I'm not encouraging you to do that. You know if it's right for you. You know when your boat is taking on water. Just don't wait until that thing is sinking. So anyway, I just want to encourage people that whether it's equity extraction to buy investment property or to make moves within managing your debt, there's some opportunity out there. Equity lines, second mortgages for some of these purposes. So anyway, I am going to stop rambling and I'm going to throw it over to Jen for some questions. Go ahead, Jen. What do you have?
Clint sent us this. Is a debt consolidation mortgage a good idea if I'm planning to retire in the next 5 years? I'm not sure how to calculate the break-even point.
Hey, Clint, that's a great question. One that I don't really know how to answer, because if the purpose of debt consolidation is to lower your monthly bills in anticipation of your retirement, then yeah, it may make sense. And you could lower your monthly bills and still apply that additional savings towards the principal to pay the mortgage down quicker. But if you've got time, interest rates may be better in 5 years. But I don't know what your debt situation is. If you're struggling now and you're trying to set everything up, it may make sense. But we're talking about an interest rate environment we haven't seen in decades. So if you've got time to wait, that might make sense too. So a little back and forth because I really don't know how to answer that question. Now, from the break-even analysis, for anybody out there who wants to see what the break-even point of a refinance is, that's a pretty easy calculation. If you look at what it's going to cost you to do the refinance versus how much you're going to save each month. Let's say the closing costs are $10,000, and I have no idea. I'm just guessing. And let's say you save $500 a month. That means it's going to take you 20 months, right? 10,000 divided by 500. Your break even on that transaction is 20 months. And I know somebody out there is saying, yes, but you're going to get your escrow back and you need to credit that. That's all true. But this is just a simple way to calculate your break even point. So that part of the question was easy to answer. Take your total costs and divide it by your monthly savings, and that's going to determine the number of months it will take you to break even. And guys, that's also true with an interest rate buy down. So if you're going to buy your interest rate down, let's say you ask the seller for You're buying a $400,000 house and you're going to take a $300,000 mortgage. And instead of offering them $390,000, you offer them the $400,000, but you want $10,000 towards a seller contribution. So you're paying $10,000 more for the house than you could buy it for because you're asking them to give that back to you. So logic would dictate that they're going to take the $390,000 for the house because that's really what they're taking. That's their number anyway. And then that $10,000 will buy your interest rate down a full percentage point. Calculate the savings on the payment and divide that by the $10,000 to determine, what's your break-even point versus your strategy for how long you're going to be in that property? And then you'll know if it makes sense to buy that interest rate down. So total cost divided by savings is how you get that number. Anyway, I didn't mean to go long on that one, but I get that question often, so I wanted to take the time to kind of flush that out. Hey, Jen, throw me another question.
Tasha sent us this. I just want to say thanks. I heard you talk about using our wedding registry for down payment money. I talked to my parents and fiancé. They are on board. My dad already downloaded the app. Thank you both. You're welcome, Tasha.
Yeah, yay, Tasha, and yay, Tasha's dad. Man, I'm super, super excited for you. Guys, if you missed that, I think it was last week. Correct me if I'm wrong, Tasha. Wasn't it last week we talked about that? So we again, looking for the opportunity in the market in any instance. And we talked about using your wedding, and instead of a traditional wedding registry, set one of these apps up. And we talked about Zola to receive gift funds for a down payment. And I even took it one step further and said, do a virtual wedding, save everybody all that travel time and travel expense, and encourage them to be super generous with their wedding gifts in the form of a contribution towards your down payment. So, Tasha, I'm super excited that you're going to give this a shot and that everybody's on board. I know your dad's got to be thrilled because, I mean, I'm sure this isn't your case, Tasha, but we also talked about statistically over half of first marriages fail. So you might as well bank on some equity. That seems to be more of a sure thing than a successful. I know, I'm kidding. You guys are going to live happily ever after in that home with all that equity that you're going to build over time. So I am super, super excited. And if anybody has questions about that, I'll be happy to share what I know. Some of the apps make it far easier than others, so I'm happy to share whatever I can to make it easier for you. But yeah, way to go, Tasha. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. On the other side of this short break, we'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. Just call or text 855-462-7292. That is the Anytime Hotline. Jenn is womaning the hotline, and she will get your questions on the air. Or head over to MrMortgageRadio.com, the new and improved MrMortgageRadio.com. Click that big yellow button in the middle of the screen that says Get Your Questions on the Air. Type your question, hit submit, and Jenn will read your question on the air for you. That's MrMortgageRadio.com. Hey, but speaking of Jenn and speaking of your questions, we had some great ones so far, and a big win with Tasha using the Wedding Registry app to collect gift funds for their down payment. Super, super excited about that. Let's see if we can't keep the fun rolling. Hey, Jenn, do you have another question? Okay, go ahead.
Eva sent this. If we go with the rec refi, can we roll our solar panels into the new mortgage?
Hey, Eva, that's a great, great question. The dreaded solar panel loans, right? Man, nobody seems to know what they're getting themselves into from the finance side of things with those doggone solar panels. But yes, as long as you have enough equity, you can roll the solar panel debt into the rec refi. So not a problem. We do it often. The solar panel companies are a little bit slow to respond with payoffs, but yeah, we're getting it done. And guys, anybody out there who's curious, the rec refi, REC, stands for Reduce, Eliminate, and Consolidate, RECREFI.com. You can punch in all your debts and use that calculator to see if it makes sense for you. But yeah, I appreciate that question. That's a good one. Doggone solar panel loans. A lot of people don't realize that acts like a second mortgage on your home. So we see people who are trying to sell a home with solar panels, and the buyer's not aware that they need to assume that loan. They need to qualify for that loan from the solar panel lender standpoint. And then the mortgage company that's issued the approval for the buyer needs to know about that second loan because the combined loan to value now has to be evaluated. So we've seen deals fall apart because there's not enough equity for the seller to pay it off and the buyer's not qualifying from a debt to income ratio. So if you own a property with solar panels, just start that process early if you're selling it and you intend the buyer to assume it. And I know that wasn't your question, but it just got this old man's wheels turning, and I wanted to throw that out there because we do see that pose a bit of a challenge from time to time, and you need to know that going into it so you can have an adequate workaround. So, but I appreciate your question. Hey, let's keep it moving, Jenn. You got another one? Okay, go ahead.
Austin sent a text. I see low interest rates being advertised by some builders. Are the rates for an owner-builder construction loan this low too? They both are new construction.
Hey, Austin, great question, my man. And logically, they should be, right? Because they're both new construction. But that is not how the rate is getting that low for the builder to be able to offer it to their buyers. So you can buy the interest rate down as a builder to encourage activity in your subdivision. And we're seeing a lot of that right now. If you're buying new construction, you know exactly what I'm talking about. You're getting a very, very attractive interest rate quote. Oftentimes the builder is buying that rate down for the buyer. The other way, and we're going to see this slow down a little bit, some of the savvy and larger builders did what's called forward mortgage commitments. And the best way I can explain that, if you're as old as I am, you remember when JetBlue dominated the low fare market. They had that fly anywhere for $29 thing going for a while, and no one could figure out how they did it. Well, they bought fuel contracts when jet fuel was super, super cheap, and they were able to pass those savings on and just essentially buy the business. They cornered the market on low fare flying, and now they've earned that place in the market. So builders did essentially the same thing with mortgage money. So I don't want to completely take this conversation off track, but they're able to offer those low interest rates not because it's a new construction property, but because of one of those other strategies, either a forward commitment and they just prepaid for a bunch of cheap money, or they're using some of the profit built into that sales price to buy the rate down. So you going owner builder with your own construction loan, you're not going to have those same opportunities. So great question though. And I understand the logic. And guys, we opened the show talking about opportunities in the market. that's one place we're seeing more and more sellers willing to play ball, if you will, with a seller contribution, and that can be used for an interest rate buy down. And what's happening as interest rates continue to march up, there's fewer and fewer qualified buyers. Now, it still hasn't tipped the scales into an oversupply, but sellers are starting to realize there's fewer people able to buy their property. So using a seller contribution to buy the rate down makes your property that much more attractive if you're the seller. And it would operate in a very similar way that we're talking about with some of these builders. So great question. I hope that answer helps. Probably not what you wanted to hear, but I hope it at least clarified things for you. Hey, Jen, can you throw me another question?
Elsie sent this one. If we take a reverse mortgage, what happens if the housing market crashes? Is my reverse mortgage secure?
Hey, Elsie. This is a good question. I'm not sure I completely understand what you mean. Is your reverse mortgage secure? I guess let me say this. If you take a reverse mortgage now and property values plummet, they can't come back and take that money away from you. They can't take the money out of the equity line portion of it. It's secure in that sense, in that they can't renege on the deal that they made with you, if that makes sense. Unlike an equity line, if you went out and you took an equity line and you didn't use it, and then property values go down, the bank could reduce the line or close it out completely. And we saw that happen in the early 2000s. So from that sense, it's secure in that the terms of it can't change. They can't come back looking for their money, and they can't take anything out of that credit line. I hope that helps. I'm not quite sure I understand the question. If you need more information, please call me and I'll be happy to talk with you off the air about it. I hope I hit at least around the nail head with that answer, but good question. And guys, a lot of people are really concerned in this economy. And we talked about opportunities that exist with all this equity. Well, the reverse mortgage is one more of those places. And as I was just mentioning to Elsie, once you take that loan out, even if you leave all of it in the credit line, meaning you don't take any cash at closing, you just leave it all in the credit line, earning interest, by the way, so that it's there if you need it, well, that number can't be reduced because your equity position's reduced. Once that loan's closed, that money's yours. So I just wanted to throw that out there because that's one place that reverse product is wildly different than, say, a traditional equity line. So anyway, Elsie, I appreciate your question. Again, I'm not sure I answered it. If you need more information, you know how to reach us. I'll be happy to talk with you off the air. But hey, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and we call it that because it rings right here in the studio when we're on the air, but that also forwards to my office the rest of the time. So if you need us, you can reach us at 855-462-7292 or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. There's a big button in the middle of the screen. You can't miss it. It says get your questions on the air. Click that button, follow the instructions, and Jen will read your questions on the air. Man, we've had some great questions this week, from wedding registries to reverse mortgages to rec refi. You guys are bringing some great questions. Let's keep it rolling. Hey, Jen, do you have... Okay, go ahead.
Molly is asking, how do we know what to use for the rent on a vacant duplex if we use the landlord loan? Is it what we will rent it for or what the prior owner rented them for? Thanks. We love the show.
Hey, thanks, Molly. We love that you love the show. And that's a brilliant question. And a lot of people have this question, so I'm glad that you brought it up. With the landlord loan, and we talked about it in the opening segment, we're seeing people capitalize on the opportunities as the rental population continues to grow, that percentage of our society. And people have so much equity, they're pulling some equity out and using the landlord loan to buy a property as a rental investment property, because the landlord loan does not require us to look at your personal income. We're looking at the rental income from the property, or in this case, because it's a vacant property, the market rent, right? So how market rent is going to be determined when the appraiser does the appraisal. He's going to determine what the resale value of the property is, but he's also going to look at the market rents in the area for comparable properties. So to answer your question, with the vacant property, we still get to attribute an income to the property, but it's going to be based on the rental comparison analysis that the appraiser does as part of his or her opinion of value when they come out to do the appraisal. So to answer your question, it's not what you're going to rent them for, nor is it what the previous owner rented them for. It's going to be based on that rental comparison analysis done by the appraiser. So I hope that helps. And if you'd like, I can run one of the free value reports for you. And as part of that value report, there is a projected rent for the property based on averages as well. And sometimes that gives you some insight whether it's a good property at that price. So anyway, happy to run that for you. Just go to MrMortgageRadio.com and click on that free value report link. But great question. Thanks for that one. Hey, Jen, throw me another.
Nick emailed this. How does the interest work on a debt consolidation mortgage? Is it higher than regular loans? Can we use the buy down idea?
Hey, Nick, two very good questions. So yes, on a debt consolidation refinance, you can expect to pay a slightly higher interest rate. And, the bank has determined a higher risk on a debt consolidation loan than a traditional purchase. So they hedge some of that risk by charging a slightly higher interest rate. Whether it's fair or not, that's not for me to say, but to answer your question, it is a bit higher. And then as far as the buy down goes, yes, you can buy the rate down yourself. You don't need a seller contribution. Where the seller only buy down comes into play is if you're using one of the 3-2 or 2-1, one of the step up buy down programs. Typically, those are required to be paid for by the seller or the builder. But if you're talking about a permanent rate buy down, you can do that as part of the refinance. So I hope that makes sense. And using that rate buy down will offset the increased rate in most instances. So great question. I appreciate that one. Jen, can we get another in? Okay, go ahead.
Trina used the website tool for this one. I'm intrigued by reverse mortgages, but worried about my kids' inheritance. How can I know how much I'll have left to leave them?
Hey, Trina, that's a great question. But before I answer it, thank you for using the new question tool on the website. I am super excited. I don't know why. The little things excite me at this age. I'm just happy that it works. I had waited some time to have that added to the website. So I appreciate you checking it out and using that little tool. But let me answer your question because it's a great one. The way the reverse mortgage process works is with just your property address, your birth date, and the value of the property, which is easy to determine with that free value report, and your mortgage balance, right? Those 4 pieces of information, we're able to run what's called a proposal package. And in that package is an amortization schedule and a projected property value growth analysis, as well as the mortgage balance growth analysis. And most people find that super, super informative and helpful when they're trying to plan for the future and know that they're still going to leave their children with some equity. So I hope that helps. I'm happy to run that proposal for you. Again, we just need your birth date, your property address, your current mortgage balance if you have one, and then we'll take care of the valuation report. So if you have those 3 pieces of information, birth date, property address, and current mortgage amount, if any, we can do the rest and put together one of those projections for you, and you can see it however far you want to look ahead and get a good idea based on the forecasts and the projections what equity position you would be leaving your children in. So great question. I appreciate that one. Hey, Jen, can we get another one in? Okay, go ahead.
Samantha sent us an email. We really like the plan to buy homes for our children now. I think you call it layaway. Is an equity line the best way to go for the down payment?
Hey, great question. Man, we've got everybody paying attention today. Guys, we've talked a lot about that first home layaway program, and you're right, that's what we call it. The equity line is often the best choice for that. It's not always the best choice, but often the best choice, and I encourage that to be the first place that we start. But guys, we're talking about a strategy where you pull some equity out of your property and you buy an investment property, a rental property, and you rent that property out until your child is old enough and ready to go out on their own, and then you sell that property to them with the gift of equity strategy, so that you've basically put their first home on layaway, securing the property now at today's property values, so that, a lot of people are really concerned, how are their kids or grandkids ever going to be able to afford a property? And we talked about it in the opening segment with that Adam data report that came out that said 99% of the people in that study area, which was 575, I think, U.S. counties, 99% of people couldn't afford to buy in the county they live in with a $71,000 a year income. So this first home layaway strategy is getting steam, and I'm happy to answer any questions anybody has about it. That was a great question, Samantha. Thank you for bringing that up. One more demonstration on the creativity in this market, right? Using some of that equity to put your kid's first home on layaway. I love that. Hey, Jen, do you have another question ready? Okay, go ahead.
Here's one from Ann. We are listening to your show while visiting family in Florida. Can you help us with a mortgage in Virginia?
Hey, Ann, that is a fantastic question, and one that's very easy to answer. Yes, ma'am, we can. We can help you in Virginia, and happy to do so. Guys, if you can hear my voice, the Mr. Mortgage team could be your choice. As cheesy as that sounds, I love it. Guys, we have team members everywhere that the show is being broadcast. So Virginia is definitely on the board, and I can help you myself in Virginia. So appreciate that question. Guys, you hear the music, you know what that means? Jen is pulling me out of the studio. We have wrapped up another episode of the Mr. Mortgage Show. Man, I love doing the show for you each week. If you need us during the week, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. One more time for the kids in the back, MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here, same time, same station. Guys, have an awesome week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
Drowning in bills? Struggling with mounting debts? The REC Refi is here to throw you a lifeline because your dreams matter, and so does your financial wellness. Visit RECREFI.com. That's recrefi.com. The REC Refi, Reduce, Eliminate, Consolidate. Visit recrefi.com, your beacon of hope in a sea of debts. A service of Mark Eitel, NMLS number 1929005, and the Mr. Mortgage Team.